Hey guys, welcome to the chapter 3 of Trades About to Happen. Um, let's get started. Story of the so I cannot stress enough the importance of drawing lines all over your charts. They tell a story and make the price volume behave. They define the angle of advance or decline in a price trend. Alert 1 to when a market has reached an overbought or oversold point within frame frame trading ranges depict prices coiling to a point of equilibrium X and help forecast where to expect support or resistance or corrections. We will begin with a study of soybean oil. Figure 3.1 shows price movement. Figure 3.1 shows price movement on the daily continuation chart of soybean oil between December 2001 and May 6, 2002. Okay, now let's assume today is May 6th. Okay, and we're beginning to examine the behavior on this chart. I first begin with the support and resistance lines. Support line A is drawn across the January 28th low here, and then resistance line B is drawn across the February 5 high, and resistance line C across the March 15 high. Now by extending these horizontal lines across the chart, we see how later corrections in March may form support along line B when a line alternative serves as support and resistance. I refer to this as an axis line support. Serves as refer to them as axis line. Prices tend to resolve around these axis lines. In their monumental work, Technical Analysis of Stock and Edwards and Maggie provided one of the most extensive discussions of resistance lines. While they never mentioned axis in the context described above, they duly noted the phenomena of horizontal lines alternating with both support and resistance. But here is the interesting and the important fact, which curiously enough many casual chart observers appear never to grasp. These critical price levels constantly switch their roles from support to resistance and from resistance to support. A former top, once it has been surpassed, becomes former top. Once it has been surpassed, becomes support. It becomes former top once it has passed becomes a bottom zone in a subsequent downtrend, and an old bottom once it has been penetrated becomes a top in a later advancing phase. Now on the support resistance lines also frame the two trading ranges on this portion of the chart. By drawing the lines, we can better observe the attempts of either side to break out, okay, as took place during the trench warfare of World War I. The numerous false breakouts on either side of a trading range are important tests of the opposing forces' strength. So this is the numerous force. The numerous force. As we will discuss later, many low-risk trading opportunities are provided by these tests. Only one important trend line can be drawn at this stage of the market's development. In figure 3.2, trend line T, trend line T is drawn across the March high. Okay, so this March T dash, this one, right? This is a normal up channel where a support line or demand line is drawn across two lows and a parallel resistance line or supply line is drawn across an intervening high. Okay. Now, in this case, let's first draw a rectangle here. See, we are focusing this one. So in this case, the intervening high would be in late February. Intervening high would be in late February. Given the subsequent price movement, a line across the actual intervening high would be meaningless, right? Because draw high, it would cross the price action. Therefore, it is drawn across a higher point on the chart. The angle of advance depicted by up channel T prime is not steep and will not contain a larger rally. Two minor up channels are shown in T prime, right? This one, channel, this channel, T and T prime. The first of these from late February to March, this one, late February to March. Is a normal channel. The slower price rise from the March low to the April high is also framed by a normal up channel. Okay. Now, notice how the market rose above the top of this channel in April and also above resistance line C, right? Without following through. The rise above the supply line, okay, actually follow through didn't happen, right? Notice how the market rose over the top of this up channel in April and also for resistance line C without following through. The rise above the supply line of the channel created an overbought condition, okay, that is more reliable than those provided by mathematical indicators. Without getting too far ahead of ourselves, the position of the close on the top, they indicated the market had made supply selling. The downswing from the April high is too steep for drawing channels, so a simple down trend line is at certain points in the struggle between buyers and sellers. Prices often arrive at a nexus or confluence of lines. Many times these areas produce important turning points. At the April high, we see the supply line of a minor up channel meeting resistance. At the May low, we have trend line T, right, resistance line B, and a minor downtrend line coming together, right? Okay. Where there is such a confluence of lines, one should be alert to the possibility of a turning point. I rarely establish a trade based on the evidence of trend lines alone. As will be discussed later, other factors are taken into account. However, if one wanted to make trades based on only one type of technical phenomena, the lines would serve as an guide. Figure 3.3 shows Figure 3.3 shows the price movement through the second week of July 2002. Okay, we immediately see that the advance from the May low started with a fast 4-day rise and then slowed into an orderly stair step affair, right? Like this one. Guys, from here, then step one. Several channels could have been drawn out different turning points from the May low, but May 30, 5 days from the high, channel V, V prime, channel V and V prime provided the best fit. This rally far exceeded the top of channel T and T prime. This one and this far exceeded the channel T and T. From the June 6 high, a new trading range formed. Notice how the lower boundary of this range approached former resistance line C. Okay. After the market rallied above the May high, I would have drawn the channel labeled X, X prime from this May low, right? It is drawn by connecting the May, July lows, May and July lows, June's high, and placing a parallel across the intervening high in June, right? Before we have the study of this chart, one last picture is provided in figure 3.4. Here we see how the rally from the July low moved slightly above channel X and X prime, creating an overbought conditions, right? Okay. Resistance line E is drawn across the July high. This July high. From this high, the market declines until it finds support along line D. After prices surge again, trend line Y is drawn. This one, trend line Y is drawn. It is the line X prime from a rising wedge. While I'm not interested in looking for geometric patterns, the converging lines clearly show the shortening of the right, shortening of the upper. Shortening of the upthrust. Okay. Notice how prices keep pushing through the supply line. Okay. Here, supply line of channel X and X prime, but fail to start a steeper angle of advance. After the sell-off from the last high above the channel, I drew resistance line F prime. I drew resistance line F, right? This one. The sell-off found support around line Y, and this found support around line Y here, and then it rallied well, right? And the market actually made a fractional new high above line F before reversing down. At this juncture, notice the confluence of lines: resistance line F, supply line X prime, F, X prime, and support line Y all converge at this point, right? Here, all meet here. Support line G is drawn across the low between the final two highs. Final two highs. And it plays an important role over the next few weeks. See this range market is going on, right? The strong support. So far we have dealt with only with the lines on the chart as the price movement unfold. In figure 3.5, eight of the most important points of the soybean oil chart are numbered for discussion. At this point, we discern ending action or clues about impending ending action. Point 1 is a false breakout above line C. Point 1 is a false breakout above line C. Here the market rallied above the resistance but closed below the line and near the day's low. Okay. 2 days later, the narrow range indicated demand. Demand was tired and price would fall back. Okay. So we see decline from this. Point. Price decline. Then the ensuing sell-off held on top of line B. Notice the narrowing of the price range on the low day of the sell-off. Here the sellers seemingly had the upper hand. At point 2, however, prices reversed upward. Right here, closing above the previous day's high. So we went from here and then closed above the previous day high and putting the market in a strong position. These several propelled prices higher until the rally fired in early June. Note the narrow range and weak close at the June high. Narrow range and the weak close at the June high. June high here, right? So this is the shortening of upthrust. Okay. After a pullback and consolidation, the market returned to the upper hand of the new trading range. Okay. So after the pullback and consolidation, the market came back to a new trading range, which is 4 and 5. Okay. It marked time for 3 days in a tight range before accelerating upward over the next 2 sessions. This one and then upward for the next 2 sessions. Point 3 refers to the absorption within the tight range prior to the breakout. At point 4, price rallies above the up channel from May low. The position of the close indicated selling was present, right? So at point 4, price rallies above the up channel from the May low, right? From the May low, and the position of the close indicated selling was present, right? And the position was because close below the support line, resistance line. Also we have this trend line, so it shows the presence of selling was present, right? The pullback to point 5 tested the area where prices rose vertically. The pullback to point 5 tested the area where prices rose vertically. The position of the close at point 5 reflected the presence of buying. At point 6 and 7, we see absorption as well. 7, we see how prices are struggling to continue higher, which is shortening of the upthrust. A reverse trend line dash could have been drawn across the high of points 4 and 6 to highlight the market's lack of upward progress. The fractional new high, point 8, along with the weak close, indicates that demand is exhausted, right? Demand is exhausted here, and the cumulative behavior between points 4 and 8, with the exception of point 5, 4 and 8, indicates the uptrend in soybean oil is trailing and increase the likelihood of a correction. Okay. The high volume break C arrow below support line G indicates the force of selling had overcome the force of buying. The buying attempted to the buyers attempted to recover the ground lost below support line G. However, the rallies ended with weak close as the sellers thwarted both efforts. All of these points will be discussed in later chapters. Okay. The kind of lines we have drawn on the daily soybean oil charts can be applied to longer term charts as well. Okay. So this kind of lines we have drawn on the daily soybean oil charts can be applied to longer term charts as well, and they help focus one's attention on the larger battle lines, which in some cases have provided support and resistance for years or decades. An awareness of a market's position within its historical framework fits the needs of the stock investor as well as those of a position trader or commercial operating in the futures market. The long-term support resistance lines, trend lines, and channels in conjunction with the range of the price bars weekly, monthly, yearly, and the position of their closes can be interpreted in the same manner as illustrated in the preceding discussion. With the study of the long-term charts, time marks only difference. Price movement on an hourly or daily chart can be interpreted much more quickly than with monthly or yearly charts. Yet the biggest rewards come from recognizing when long-term opportunities are developing. From this information, we can then zero in on the daily chart. Soybean oil in 2002 was such an opportunity. Figure 3.6 shows yearly cash soybean oil prices from 1931 to 2003. It tells the story of many commodities over the past 75 years. Price bottomed in the early 1930s at the depth of the Depression. Here, price rose into the high of the late 1940s under the stimulus of the Marshall Plan. Price entered a period of extreme dullness until awakening in the late 1960s. Here, prices rose sharply during the mid 1970s. Under inflationary pressure, right? Prices entered extremely volatile trading range until bottoming in the 1999 to 2000 periods. Okay. This has been the general price pattern of many agricultural commodities produced in the United States. Horizontal resistance lines are drawn across the 1935, 1947, 1947 and 1956 high. Look at the market's interaction with these lines. Between 1952 and 1972, soybean oil stabilized on the top of the 1935 high. The 1956 high was blown away by the meteoric rise, right? The 1956 high was blown away by the meteoric rise in 1973. So here we basically crossed this resistance line thanks in part to export demand. This explosive rally carried through the 1947 peaks. 1947 peaks, right? Here, then, but the gains were short-lived as prices promptly reversed back to the area of the 1956 high. 1956 high, right? A new trading range developed roughly on top of this previous resistance level after 1985. Prices coiled for 13 years into an apex. This is our apex, and prices were going up and down in this area. Support and resistance lines. The breakdown from 1998 to 2000 was a terminal shakeout of the larger trading range from the 1975 low. Okay. In 2001, shortly before our study of the daily chart began, prices reversed above the 2000 high and closed near mid-range. Right? This put soybean oil on the springboard for a much larger up move. And understanding of the market's position on the long-term chart at the beginning of 2002 gave greater meaning to the turning points in May and July. By early 2004, prices had rallied into the 34-cent area. Prices doubled again on the rise to the 2008 high, almost 71 cents. In figure 3.7, we see the history of cash cocoa prices back to 1930. The major turning points in cocoa line up with those in soybean oil. Low in early 1930s. I think they look kind of same. The major turning points in cocoa line up with those in soybean oil. Low in early 1930s, top in 1947. Long trading range to the low of the 1960s. Huge upwave during the 1970s and bottom at the end of the 20th century. In 1977, cocoa picked a price 74 times greater than its 1934. This is 74 times greater. 1933 low. Here. The price range in 1977 equals the distance from 1933 to 1973. Only a semi-log scale would allow one to see the earlier price history. The up channel drawn across the 1940 to 1965 lows has spent almost all of the price. 1940 to 1965. In 1977, however, prices exceeded the channel. In the following year, all the gains of 1970 were erased. The 24-year downtrend from the 1977 high progressed in an orderly fashion. Each support line provided resistance in later years, and they should be expected to play an important role in the future. I thought cocoa had bottomed in 1992. Here the downward thrust shortened. Here the downward thrust shortened. Prices had returned to the top of the 1947 resistance line, right? And they were testing the vertical lift off area of 1973. Yeah. area here, right? Although prices had almost doubled by 1998, the, the up move was too laborious. Notice the lack of upward follow through, right? I mean, that lack of follow through. After the minor breakout in 1997, in 1999, cocoa experienced an underlanting down move that ended with a close near the 1992 low here. A distinct a distinct change in behavior occurred in 2000. Here we see little downward progress but no willingness to rally. Prices narrowed into the tightest yearly range since 1971. Remember the semi-log scale draws larger price bars whenever prices decline. Thus, a cursory examination of the chart might lead one to believe the ranges in 1987 and 1996 were smaller than in 2000. However, this is not true. In light of our discussion of narrow ranges, the behavior in 2000 deserves special attention. The market simply traded traded water just below the 1992 low, right? Just below the 1992 low, and the long-term uptrend line, right? And the long-term this uptrend just below. The breaking of the trend line is not of major consequence by itself. What matters is how the trend line is broken and the amount of follow through. Basically, breaking of the trend line breaking of a trend line is not of major consequence by itself. What matters is how the trend line is broken and amount of follow through. That's very important. As you see, there is no ease of downward movement. If the sellers still had the upper hand, prices should have continued lower. In the following year, when prices reversed above the 2000 high, here the change of trend became obvious. After the rise above the 2000 high, one could have purchased cocoa with impunity. Over the next 2 years, cocoa prices rose over 200%. The behavior during 1992 and 2001 is a typical of bottoms on charts constructed for any time period. So this is true for any time period or any chart. On the early cocoa and soybean oil charts, the price action around the major support or resistance lines told the main story. On the monthly bond chart, figure 3.8, the story is different. Here we see a reverse trend channel. Here we see a reverse trend channel dashed line, right? Dashed lines that most amply depicted the angle of advance in bond futures. It was drawn across 1986, 1993, 1986 and 1993. Here, this one, here and here. So 1986 and 1990 here. 1987, 1993 highs with okay, it's this one, 1986, 1993 high. Okay, as with a parallel line across the 1987 low. One, this one, this one. This one. A second parallel line was drawn across the 1990 low, and is provided support in 1994 and January in 2000. Right, support in 1994, here, January. Okay. Since it was first drawn, the lower parallel line has never interacted with price. The rallies in 1998 and 2000 penetrated the upper line of the reverse trend channel, creating a temporarily overbought condition. Okay, so 1998 here, right? See this one. Alright, guys. I think we'll stop here and I'll continue forward from by looking at on continuous monthly chart. I'll see you in the next.